I'm about to maybe the other next thing. We don't sort of start the next curve. And what I were talking about yesterday was this parallel thing where the potential pension fund managers have to start on the first curve just as we're trying to start on the second curve. And so we're, I think, still trying to figure out what it takes to have outsized impact. At the exact same time when the world is thinking about this and is starting to say, hey, wait a minute, maybe I can allocate some of my capital. And to me, those seem like very different conversations and potentially competing conversations. So I think our challenge is simply how to manage those two things. And when I look at, although I don't think, of course, this panel or even the conference is really good about how to mainstream. Thankfully, we got beyond that. Just a couple of observations on things that have become more mainstream. I think if you look at microfinance and you look at kind of incorporating risk-adjusted, incorporating kind of environmental concerns in the public market, right? Microfinance, the argument basically when we can get to a reasonable rate of return with a low beta instrument. And so the whole language was the risk return profile actually was pretty good. And then even if you take a generation investment manager or anybody who's incorporating environmental concerns into a public markets portfolio, they're also basically saying this is a better way to realize long-term value and manage risk. So I don't think the world has seen a significant amount of capital come into a new investment class that is not speaking the language of risk and return, kind of traditional fashion and kind of putting bait into that equation. It feels to me like where this market is, if you will, is saying in a serious way that there's significant segments of the marketplace, but unless you consider impact as an endogenous variable that actually matters, those trade-offs are not going to fully work out. The sooner we can start having those conversations, the better. It's kind of a messy answer, unfortunately, because it will be better if it will all get to snapping fingers and make it work.
But I think that's some wood chopping.
I think we have some wood chopping to do, and that's where I think that the sooner we can have the honest dialogue and honest conversation about what you get for what the trade-offs are, what it will take to create impact, and the sooner we can actually construct a capital market that aligns with the realities of doing the work. I guess I feel like we were talking about before that we created a capital market that looks a lot like another capital market we created about 50, 60 years ago, which is something that you mentioned private equity. And that was created to optimize for different set of things. And so I think we're just beginning to realize that this is not a little bit different, but potentially a lot different. That's what they need to look at.
Yeah, and they take tools and they take practices. Certainly we want to encourage the natural forces, or at least the rules of engagement, different behavior that we've seen so far. You heard me talk about muscle memory. I think sometimes we suffer too much muscle memory when much time in the past in the way that your capital's been successful, but maybe try some new things. So speaking of new things, Miguel, you've been working through a factoring line, plus you're an investor, and you've worked very hard to build capital lines, and so you've had some robust conversations. Could you just describe what you mean by a factoring line, how that's going to serve us with the support, capital support for social enterprise, and how you came to it?
So I'll start by saying kind of the background. So I run investor development to the seed stage investment fund, and that was where the idea for creating a factoring fund came from, because we kept going back to our companies and we said we invest equity in just equity. That's all we pretty much do with the ESP fund, which is the fund we manage. And when we looked at it, we said equity is not the only thing that these guys need, because a lot of the companies that are actually internalizing costs to make up for the fact that the communities that work in lack infrastructure. And by and large, what they lack is financial infrastructure. So when you look at it and say, there's no GMAC, there's no Visa, there's no lease finance, there's no rent to own, all of those things don't exist in those markets. So if you have a company that's selling a technology, they're going to have to go and figure out how do I finance that for the end user itself. Which means if I'm taking equity, which is by far the most expensive capital in the world, and any entrepreneur out there, remember that, it's not free money, it's very expensive. So if you take that equity, you try to internalize all of those costs, and then you're going and using that to finance your product, you end up in a big hurt for these companies. So what we saw is that the equity model that works great in Silicon Valley, that helps grow companies, well, it doesn't work that well when these companies can't grow quickly. And they can't grow quickly in part because it's working capital. So the factoring fund was designed to solve that problem. And what factoring is it's accounts receivable purchasing. So every time the company sells something on credit, they have a contract that says that X person is going to pay in a series of payments, right? And that contract is an accounts receivable, because I'm a company and I don't have that money yet, but I have a contract that says you're going to give me that money. Well, that contract, we buy it from the company. So we say we will give you a percentage of the value of that contract today, and then we're going to collect it over time. So that's an accounts receivable contract. You can call it accounts receivable discounting. You can call it factoring. I think we called it factoring honestly because we're not finance guys and we didn't know that there was a difference. And we just kind of thought that was the first thing that came up with. So that's how we got good lawyers. They figured out the detail. But that's how it kind of started. We knew we wanted to solve the problem. We knew a working capital loan fund wasn't going to work because working capital requires, and lending I do know a bit more about. But if you're lending money to a young company, you have to do a risk profile when you're lending money to a company. And a startup almost never has the appropriate risk profile for lending. So that means that I have to look at this company and say, what are your assets? What is your income? What are your revenue lines? What does it look like? And that's a very different assessment than when I come in there and say, I'm purchasing an asset from you. And that asset is that contract. So the factoring model actually works better. It also works better because it doesn't mess up the debt to equity ratio with most of these young companies, and they're always fundraising, so that helps. And the other reason that we did it is because from a regulatory standpoint, factoring is the Wild West, which is in one way why you'll find that there's a lot of people who make a lot of money doing factoring. But in this sense, that means that it wasn't nearly as regulated, and so we're able to do things with a lot less red tape. And that makes it easier in our part because we're a small fund and you're getting a new product off the ground and you want to kind of reduce the regulatory burden.
Terrific, thank you. So Andy Lowe, from Elios, has an interesting perspective in that he's on back to say, what would have happened if I used a different form of financing for equity investments that I made? And Andy, maybe just bring it right from there. And
yeah, so maybe by way of background, just to explain a little more about what Elios does. We, as a foundation, private foundation, make early stage investments with our capital in the range of $20,000 to $50,000 with real early stage investment opportunities, seed opportunities. And then we have a wholly owned for-profit subsidiary, Elios Investments Management LLC, and that manages other investments to invest through us. And that's typically a minimum of $10,000, and we group the investors together to make investments in the range of $100,000 to $1 million. So we're coming in really early, and we're trying to find ways that win-win scenarios in the way we look at investments. Excuse me. And because we're coming in so early, we're trying to make sure that we're actually finding ways that make sense for the long-term liability of the organization. And like Eva, we are hoping to have a financial return, and we do believe that even though we're using third-party capital, we can actually add value for the market by providing more value for the market by driving towards making sure that we do have financial returns. So we've made investments, we've done straight debt investments, we've done convertible debt, that's kind of been our default and our go-to, and we've also done a straight equity investment. And so the question is, when we were talking with John at the time, was what could have been done differently if I could go back in time over the last couple of years, especially with regard to equity. What can we do differently so that we can actually get those wins, like you were saying, to show the model is working, to good for us as the Elios Foundation to actually get money back to invest for us, but also much better for the space to actually have more points on the board to get some wins that improve now. And so the traditional model that we're talking about has been, equity, debt, and if they were to really do convertible. But I think there's a growing movement, a growing awareness led by many of the panel, is there a different way that we can actually sell the equity to actually make a different impact? And so I've gone back to the entrepreneur that we're working with is Chip Liberty of Justice, who many of you have heard of. He's not here, so I won't speak too much background behind that. But we could have a conversation, a what-if conversation, although we should have done this differently, but what would have happened if we had done this differently rather than just having a straight equity investment? What would happen if it could be related to royalties, could be related to purchase orders? If there had been a way where we as the investor could have seen a quicker light at the end of the tunnel, rather than where we currently are at, there is still a light at the end of the tunnel, but the tunnel seems to be incredibly long, and the journey of liberty and justice is going to be a winding road, which we're very happy with, we're very keen where it's going, but it's going to be a lengthy process, and is there a way that we can actually get some wins for us to be able to get some capital back that would have allowed for investors to continue to be engaged and to make it easier for investors to re-engage. So the conversation that we've been having is there a way that we can set these things up to be actually find a way to align with the reality of the situation rather than the theory of where venture capitalism was 50 years ago, 40 years ago, 20 years ago, whereas the reality for active investing. So the question which has been, would it have made a difference if we'd had a big team of purchase orders? Would that have forced him as an entrepreneur to net purchase orders quicker? Because he'd have been on the hook for it with the investors rather than just having equity. Would that have helped him to streamline his business plan more? Would that have helped us as an investor to be adding more value to make sure we net purchase orders? And very much what ifs, like I said, we're very close to our thing, but one of the things that we're really keen to do at Elios is to be part of the learning community to go for sourcing the what if scenarios, what would we do differently, what can we share with other people who are working with us, and what can we share with other people so that people do it better than we are doing at the moment and better than we did a couple of years ago.
Terrific, Bill. Go ahead.
Something that Andrew said. You said adding value along the way in order to get a company like Liberty and Justice to a place where they could actually pay back in the shorter or longer time frame. And I think that's an important component of equity alternatives is the technical assistance capacity building mentoring or whatever you're calling it. And the ability for the investor to help the company in the ways that they can, whether it's Beyond Capital Fund providing pro bono or Elios providing kind of business mentoring or even kind of aggregating that type of support. I think it really helps to allow the business to kind of go further.
Terrific. Thank you for that.
Thank you.
The thing that strikes me, I've heard so far that the amount of time that capital is in the market is an issue. And you brought that up, especially in terms of you want to evergreen your foundation capital, put it back to work. But I also think it's an issue in terms of market risk because these are frontier markets, and often there are adverse things that happen in frontier markets. We don't really acknowledge that as much. But going back to the thinking about limited partners and new sources of capital. And Sasha, knowing that you have some thoughts about the role of limited partners as it relates to how they can encourage fund managers to think differently and to behave differently, what would you advise Abigail in her conversations with potential LPs in terms of their LP activism?
That's a really hard panel. This wasn't easy. I think that, I guess my hope would be that the limited partners who have been closest to sort of the closest version of this space will continue to lead, or would lead more. So public sector institutions in particular in various ways, whether it's the IMC or European institutions, have been investing money into emerging markets in lots of different ways for decades. So in a lot of ways they have the most experience with that. But the complexity there is their experience with that is with a segment, so building a mall in wherever in Vietnam is not the same thing as building a water business in rural India. So I think that to the extent to which the LPs can become more actively part of the conversation, and especially those that have public monies can start to say, well, actually, what business are we in here? And are we in the business of using public monies to create social change, or are we in the business of being private equity emerging market investors? And I think those are quite different businesses. But I think it would be unlikely and unreasonable to expect that a pension fund manager with fiduciary responsibilities would be able to leap forward and kind of leapfrog the practice of these other institutions with these really big balance sheets. So I think it's a parallel conversation, and then yes, occasionally, maybe both from a regulatory perspective as well as just people who want to be thought leaders and create some alignment. But it seems to me that it would not be realistic in my mind to expect the newest entrants, the newest capital coming into the space to take the most sort of aggressive position.
Yeah, probably true. What do you think about that, Abigail?
I completely agree. So definitely if you're entering, you probably want to take a less risky role and kind of do a pilot and get your savings a little bit. And I'm thinking about the public sector investment that's coming in is that it helps build the ecosystem and it creates the foundation on which the LPs can come in and just layer on top of that. Sorry. So,
Yes.
did you guys hear any of that? So basically the public sector money helps create the foundation and the soil on which the LPs and other investment capital can kind of build on top of that. So if you're going to go into emerging markets and just layer on top of that. Sorry. So You guys hear any of that? So basically, the public sector money helps create the foundation and the soil on which the LPs and other investment capital can kind of build on top of that. So if you're going to an emerging market and you're going to bring in all these different sources of capital, thinking about the unique goal and what they want to get out of it, whether stronger on the social impact, stronger on the financial return, especially in the building space.
It reminds me that Al Gore and Bill Clinton and Barack Obama now built the internet. Actually, it's true, or did build the internet. So is there a role then? I think, Sasha, you said it's parallel discussions with both the experienced LPs and then maybe with some sensitivity that there might be new limited partners with large assets to bring to bear that have to feel comfortable. So what we need to do as a group of practitioners is lower the risk. And one of the things, I talked about Eva's discussion on capital stays in there too long. Can we take a page from the microfinance industry where they were able to build investor confidence and get greater and greater capital participation because they had frequent return capital. It had some rate of return that ultimately ended up being acceptable to the people who were putting forth the capital. They treated the credit that they were receiving very preciously, and their rates of return were at default rates that were lower than consumer credit in the United States. And so people are going, my money, my savings account can go in part to some of these microfinance organizations. I can get some return, but I know that my money's doing good. And I think that round trip of capital is not only good for risk reduction, but it's also good for establishing a very frequent return and a history that then gives people the sense of reliability. And in my perspective, reliability in this market, in this nascent impact investing space, is trumps alpha. We don't need to be going after 10x or 20x kinds of investments. I would rather have us go after reliable return of capital plus some coupon or some multiple. And sometimes you'll have a great multiple, and sometimes you'll have a fairly pedestrian with a return, but that's okay as long as it's reliable.
This is one point about that. Two things. One is we need more experimentation with these kind of products. Absolutely. Yeah. And I don't think most people are putting in equity because they think they're going to make great return. They're putting in equity because these are extremely cash flow constrained businesses. So I get it. The microfinance analogy looks like a really great inspiration that's also very mistaken. And so, because those are businesses that can turn cash flow positive pretty quickly. Mm-hmm. And I think where we do need to get is figure out where are the subsectors of businesses that in fact can have a pretty clear path from startup to actually they're generating some cash. But I just don't think there's a lot of equity going in thinking, this is going to be a 10 bagger.
No, I agree with that. And actually, I think that there's ways to also do it where you can. I mean, we invest a lot in technology, and technologies take time to develop. They're not going to get cash flow very quickly, but we can still look at it and say, as we kind of joke internally call it Moneyball finance, like the movie. We're looking for just getting on base. How can you get enough guys on base so someone's going to come home and that's going to make the fun and that's going to work. But it doesn't have to be those home runs. That we can do this in little pieces. And so one thing that we've done is say look at the term sheet and say why are we using this term sheet that really is sort of it's a boom or bust kind of thing, and that's the only two options in it. And we've added things that you can edit. I mean, the demand dividends is something that you can plug into a deal. You can take pieces of the demand dividend structure and plug that into a deal, which is something that we've talked to John about. We've also looked at doing royalty payments on the front end. We haven't used a royalty payment yet, mostly because I haven't got an entrepreneur to accept it yet, but we're working on it. And as soon as we can do it, that's another structure there too. And then there's also redemption rights. And redemption rights are something that we've become really demanding about, and we're starting to get most of our term sheets, if not all of our term sheets, to have redemption rights in them, simply because what that says is, okay, if the horizon, if that tunnel ends up being 20 years, and that there really is no exit down the road, we have a way that we can start getting back money sooner. And you can do that in 5 years, you can do it in 7 years. You really just need to sort of tailor that to the business. But that still allows you to have some of that upside potential. And it still also aligns the interest because the redemption happens at the valuation on that year. So you do a valuation. So my incentive is still to make sure that company keeps growing and growing and growing and more valuable. So it's a nice little add-in in there, and it's just another tool that helps them.
Okay, so I think I should probably explain demand dividend just at least the top line. And you'll get into a little bit deeper this afternoon. But essentially, demand dividend is drawn from venture debt. And it looks to bridge the gap between donation and where you might otherwise see equity used, perhaps even appropriate for people who would otherwise have used equity. And it takes a tax or a demand on the free cash flow, meaning not the top line revenue, such as a royalty-based financing would, or debt, just a straight debt structure would, but on the free cash flow of the entity. And if free cash flow doesn't happen in a quarterly period, it simply totals to the next quarterly period with its principal and its interest due. The interest rate is variable, set by the issuer. It has a payout that would probably be a term such as 3.5 to 5 years, and so there's a specific time that it needs to be paid out by. Or it can be replaced with a new demand dividend, but then you still have a return of capital. It encourages phased growth. It is aimed at companies, as Sasha was saying, there aren't very many free cash flowing social enterprises, but it does encourage, such as in Liberty and Justice case, it does encourage a focus on companies that are spring-loaded for growth within frontier markets, and with an injection of capital and a honeymoon period contemplated in the demand dividend of between 10 and 18 months, you can see the business velocity actually double or maybe even triple in some cases. And so that free cash flow is much more able to start to meet the percentage claim that the instrument would have. The percentage claim would be a minority share, in this case between 20 and 30% of the free cash flow underneath. And the rest of the structures, such as a redemption right, as Miguel was talking about, some of the governance structures that Abigail was talking about, are drawn from equity-like term sheets, so that there's still some protective provisions for the issuer. There's still some checks and balances in terms of the governance. So we hope that it is somewhere in between. And it needs to be tried. It needs to be some regression analysis done. And I'm hoping it might be one of the solutions, not the only solution, but one of the solutions that helps propel the impact investing world forward. So how did that sound? Is Elios ready to sign up?
Yes. No, I think it sounds great. That's it. No, I think it sounds great. I think it's really needed, and we need people to be exploring, to be able to see what does work, and to be learning, and to be sharing the learnings, and to be looking at both from the investor's perspective as well as the entrepreneur's perspective. And these are all obvious things, but I think they're things that aren't necessarily being applied as well as they could be for this case. So John and I have spoken and saying, as and when there's the right opportunity with any investments that Elios is looking at, we're really keen to explore it just to see what would work. Going on the example of Liberty and Justice, we're now doing a debt offering that will be having open over the next month or so, and it's quote unquote too early for debt in the traditional mindset, but the opportunity of having a debt option which gives the chance for investors to actually put more money in and have a chance to get back quicker, and then it gives Liberty and Justice the chance to have a 12-month runway, seems to make sense. So we're being flexible with the structures we have, but other structures are really needed, really on board.
So one of the things that we've done as a group of practitioners, thank you for that, Andy. One of the things that we've done as a group of practitioners is we have started to practice together. So one of the things that the venture capital industry enjoys is there are already pools of equity investment capital waiting for winners to emerge from previous rounds, and they're using the same tool, and it just sort of step ladders up. In impact capital, there are all kinds of different tools, sometimes with different objectives or different mission. But I see more and more of that becoming used, even within the same fund, such as Grassroots Business Fund, which has the grant-making side of their investment to be preparing some of their investees to be ready for the equity or quasi-equity side of their investment. So I want to talk a little bit about blended capital, and I'll ask the whole panel to discuss this, because I think if we squint our eyes and we say now there exists a factoring line, such as Miguel is talking about, and there exists a demand dividend, and there exists equity as we already know it, and there exists perhaps some other things we haven't spoken about, such as first loss guarantees. Is there, and Sasha, I'm going to let you start on this because you've been strong about the role, expanded role of philanthropic capital as it comes to bear on creating investment-ready social enterprise and be participating in a longer way than they have so far. But is there a way that we can blend some of this capital support, and do we have existence proof of that?
So, I think we need to try all of these things, and I don't think we should be surprised at such a young industry that we don't know the answers yet. I do think that what we've seen since the publication of the Blueprint to Scale report is a lot of enthusiasm conceptually for both the notion of enterprise philanthropy, which is the notion of grant-based, milestone-based, giving grants in a milestone-based way to prepare a company for investment. And from our perspective also, things like grassroots business fund, philanthropically funded investment funds like attuned. The pools of philanthropy are, so from the concept to the reality is a real pool of philanthropy than I would say. And if anything, it's gotten, I would say, significantly more difficult to mobilize philanthropy to do this work. And I think it's a tough question to answer, quite honestly. I think that potential funders and people who are aware and know about the space, if all of their hearing is you're supposed to do PRIs, you're supposed to do PRIs, or similarly, and then someone comes in and says, hey, what the sector really needs is $500 million of philanthropy, and then we will really graduate. I don't yet know where that comes from, and I think the rhetoric in this space is made more rather than less difficult. So I think the onus is on all of us to explain specifically what that philanthropy would be used for, and then figure out structures that might work. And so I think the Harold's structure with the Grassroots Business Fund, Blue Fund, is a pretty interesting option. It's got, I think I'll remember the numbers, so $40-ish million of investor capital and $10-ish million ballpark of philanthropy. The challenge is it's kind of up to each person to kind of roll up their sleeves and kind of raise both those buckets. And I do think a great deal of progress would be made is if, for example, investors were to allocate and say, hey, we actually have a balance sheet that allows us to put in for every $4 of investment capital, $1 of grant money, $1 TA money, whatever it would be. So that, again, usually when an investor raises one fund, if they're successful, it's easier to raise the next fund. I would suspect that Harold might say, if you were here, that if he's going to invest all this money, I think the next 10 or 15 or $20 million of philanthropy that he might raise for his next fund will be exactly as hard to raise as the prior one. And again, if it's harder for him, think about everybody else. So I think conceptually, we have a lot more clarity about the role of space subsidy and grant capital, but in terms of the execution, I think it's pretty unbelievable.
So maybe if I could just talk about the other side, meaning the potential commercial capital or more institutional capital coming in after an LES or Beyond Capital Fund initially provide the investment capital. I think one of the important principles there is aligning the principle, I guess more so the value sets of the investors. And, I think we have an investment in common which could be very commercially interesting down the road. And I know LES has a board member on they have a member of their team on the board. We also have a good relationship with the chairman of the board. And so there's a way for us to feel that there is alignment of interest if as the company progresses and it grows and it's growing relatively quickly. Now, what I would like to bring this down to is advocate that while we do have and we will have many templates, we should not necessarily take them as boilerplates. And we should look into the investor protections that we can actually get within each structure and what is specific to that deal. And that way we can protect the impact in the long term.
I think building on that, I think there's two ways of going about it. One is to raise different funds within one organisation. The other way is to see what we can be doing across the whole ecosystem. And so if we're all trying to get ones on the board, which we're all desperately keen to get, that's the philanthropists that are prepared to give the money away, and that's what they want to do, and they need to have a huge important role to play. That's the early stage investors who are prepared to do lots of the hard work, taking the risk and coming in real early, and it's the later stage, early stage investors who are prepared to come in with larger volumes of capital but need to have the ecosystem built out to make those investments. And so my big challenge for the space would be how are we working cohesively together. It's frustrating for us when we're in the early stage and the late stage investors who are negotiating really, really hard, really aggressively, And I'm saying we're trying to move the ball forward. There's no point you just coming in to make sure that your interests are met, solely your interests. We can find the win-win scenarios. That there's the win for the early stage investors, the win for the late early stage investors, and there's the win for the entrepreneur. So I think that I would just challenge the space for thinking, how are we thinking beyond just our own selfish interests and our own silos that we're building up, how are we helping to move the ball forward across the space.
Very short comment. I just don't think we're going to ask. I agree with that. It's just a question of where does the institutional philanthropy come from? Because I think we have individuals, family foundations, and then a few, your Midyars of the world, which are essentially really, really big family foundations and have a lot of flexibility, so single LP funds. I think absent major institutional players putting up a large amount of philanthropic capital, there's a risk that the individual philanthropists who in many ways created the sector at a certain point say, we gotta be kidding me here. I'm just gonna catalyze, and there's someone, 5 years down the road for this company just kind of, making an investment. And sure, we're all aligned, but can't we all, you have a big balance sheet also. Again, I'm not sure how we get there, but I do think that has to be part of this ecosystem building.
I have a slightly different perspective on that with philanthropists. I've met a lot of philanthropists who believe strongly in the entrepreneur and the theory of change or vision, and they don't necessarily see it as they're catalyzing and handing off the success to someone else. They're really excited to participate in the early stage idea, and I think there's a lot of work then to collaborate across the different capital providers, more family foundations and larger foundations, and then thinking about some of the incubators and how they might provide, as Eva mentioned, some of the technical assistance, and then tools like convertible debt, where you help the entrepreneur, you take a little bit of a leap of faith, but the upside is yours if they are successful, and then graduating that more into equity and commercial capital. So I think we can think more about this as a complete value chain of capital, and how we work with things that we believe in at the early stage, and that make sense in terms of the business model, and work with the entrepreneurs and enterprises all the way through.
There's actually something else that we've thought about too. That I think it's still pretty early and it's not quite mature yet. But one of the things that if you look at the deals early on, and if we look at how are we going to create that liquidity, as I mentioned, redemption rights, and there's all these other things, but dividends and even just traditional dividends are actually something that gets really, really ignored. And I think a lot early on it gets ignored because we're early seed stage investors. There's no revenue. There's not going to be a dividend for sure. So we don't really kind of think about it. But if you look long-term wise, those dividends can be steady streams of cash flows. Those are just straight cash flows that can become very predictable. And that can become something that is attractive to larger investors. So that we don't have to look at saying, how are we going to sell this company through an acquisition? And to be honest, and with all of our investments in the markets that we're in, IPO is not really an option. So we're not going to get the liquidity from that. We're mostly looking at an acquisition. But if you're looking at acquisitions, that could also put the impact in jeopardy, and there's all these other things. So one thing that we've been kind of sort of advocating quietly is this idea of, can somebody create a holding company that would come in and take the long term? So they would be able to, let's say, they can say, what we will do is we will buy the shares from existing investors if the shares meet X criteria. Once we have X criteria, I know how to build that into my deals. I know how to build that into my milestones, and I can start pushing a company to go that route. That gets me liquidity prematurely, let's say, before an acquisition. It still might be a long term, but it does create that liquidity. But that's something that I think the institutional players are really going to have to get into, because it's not something that, let's say, like a small fund like us can really catalyze.
Terrific. Well, good news is I think there's some of that work already underway. So hopefully we see some of these buyout or second stage funds that take the early and great impact investors into some kind of liquidity. So I wanted to make sure that we had a few minutes for questions. So I want to stop it there and have some questions from the floor. I think there's some very great minds that are in the room, but this lady in the back of the room had her hand up first. So then if you shout it out and I'll repeat it.
We've all been talking in a very interesting manner about how basically markets are not clear very well. They both the social impact of investors and intermediaries and commercial investor growth. Ourselves, the business, the bank, and some other people have been thinking that there's actually missing piece in this transparency or in the infrastructure. That I think is complicating everybody's life. And not leading to results, but looking forward to more money coming in here. And that piece is actually at the media level. You have a large number of organizations, like our mentioned, they're not profit organizations, and you have commercials that are in very different kinds of standards. Very different kinds of standards that actually really complicated. You cannot expect the market to really work very well if the investors don't have a way to compare financial returns. Because remember, I'm prepared to make a trade-off if I can't tell what my financial return is going to be and trade that off against that I'm stuck. So there's a little project that we're doing with the right, and we've done it now for a year, 4 participants, so we're trying to build a template that walks one from the other. So we all know the project every department is doing training, we're getting more, we have a lot of calls and so on. But what are we doing? What is that translate? I think that's an important missing link here. So we'd like your comment to the extent as to whether you're right that this is the gap that the market needs, or maybe not.
So, did everybody hear that, or should I repeat the whole thing? So Wendy from USAID asks us, look, is the missing piece something that venture capital industry actually enjoys, which is a very vigorous, strong service industry around quickly scaling up enterprises that have been invested in by the venture capital community? What is the equivalent in impact capital? Is that actually a missing piece?
Sorry, just because
you heard differently.
I cheated, I know my project. So there's a fund transparency project that is going on between USAID and Kohler to basically say, and DIPID, sorry. To say, look, we've got all of these funds that are actually structured in lots of different ways. And it's very hard to compare them because their accounting is so different, especially because we have nonprofits and for-profits kind of playing in the same space. And so can we find a way to look at Acumen's balance sheet and look at GBF's balance sheet and look at Bamboo's balance sheet and look at Avishkar's balance sheet and their accounting and everything and compare them all, because there's one, you can sort of take all of their numbers, put it into a black box, if you will, just conceptually, and they will come out being comparable to each other. And the actual heavy lifting of figuring out how to do that, where we, for example, we have philanthropic capital, we have investment capital, we have a leadership program, we work on impact metrics. Imagine that versus anybody at the table. And so the act of comparing, one of the barriers I think Wendy's asking about in a second, is as an LP who actually, I hear you saying, would be willing to actually say, where's the biggest return, where's the biggest impact? It's very difficult to judge between the many different firms, because you can't look at their economics and understand how they're the same kind of different. Right?
Terrific. Thank you for the clarification. Many thanks. Well, it's okay to cheat in that. Okay, next question, Max.
Well, I would actually love also to hear you answer the question from other parents. We feel like this would be, there's a lot of work going into it. It's a small number of firms, Acumen included, participating in it. And I think we want to figure out, are there 50 firms willing to do this because it's time and effort and work, and people who are in the space with various perspectives think, wow, if we could get to a point where that problem is solved, that would be our ability.
We're going to the second round of projects to finish the pilot. And the goal is then be able to speak to the aspects of DFI foundation so that we can all do a better job on lender financing and understand the space we're in.
Yeah, from my perspective, I think we lack from true empirical evidence. And so anything that promotes that, either through new instruments like we're talking about this afternoon, or through transparency and of the fund level experience, all of that is great if we can get to truth in advertising.
We're a really small fund, so the one thing I say is I always get really intimidated when somebody comes to me and says that we have to, what you need to do is transparency, all you have to do is report in this fashion, because I usually just don't have the bandwidth. We have a really small staff. We run a very, very tight budget, very tight. So when we look at something like that, I'm like, if you're going to add a dollar to it, it's not going to necessarily give me that dollar back because I already have my invested capital. It would be really tough for me to commit to it. At the same time, I definitely think it needs to be there. And for the larger funds, I think standardizing and opening that up and creating that data to where we can all look at it, so we all know how to measure ourselves as well. I think it's important. I think it's just got to be structured right so it's easy for us. Yeah. One more comment, then I'm going to take another question.
Yeah, I was going to chime in. I think it's a great idea to get uniformity as much as we can, but I think we've also got to be honest and realistic about what we're doing in this space and how the challenge of getting objective data from things that are so subjective, especially with the social impacts of driving so much what we're doing. So it's the social agendas behind it, and that's so subjective, not just in terms of the number of lives that are being changed, but our personal desires and our personal heart is making us get involved in this space. So I endorse it, but I think we've got to be careful, especially for the smaller players and smaller ones where the value add is somewhat different. We've got to be honest about the subjectivity if there is as we drive towards finding subjective data.
Okay, a couple of quick questions. Yes, sir.
For Eva, you were talking about trying to change the numbers so that instead of the traditional venture model of 120x and a couple of 3x and a lot of losers, you have a fairly consistent 2 to 3x. So if you could just say a couple words about what sort of vehicle, I mean, demand, dividend, loyalty, and also over what period of time are you looking for that 2 to 3x?
Yeah, I mean, I have to say it depends. I'm sorry to give you that answer, but it really does depend on the individual investment and the sector and the geography and all of the components that come along with it. If I were to maybe kind of put a blanket over the whole thing, I would say that, as I said, demand dividend and possibly royalty-based financing is a good way to do that. I mean, it's also very valid to use equity to get 2 to 3 times your money, and not necessarily be disappointed about it. So I'm sorry to not have the best answer for you on this one, but it really does depend on each individual company. And if you'd like, I can explain to you afterwards some examples of that.
No time frame objective at all, you could say?
Well, I mean, the investments that we have right now, we envision that it's kind of a 10 to almost 12-year payout, and those are very equity-like type investments. And so, ideally, we would look for maybe a 5-year time horizon, but because of the nature of the companies we're investing right after the pre-revenue phase. And so because of the nature of their activities, also pioneering in the markets in which they're working, I would envision a timeline to be more about 5 years. However, this is new for us, and we are experimenting. And the good thing about what we're doing and the fact that we're a foundation is that we are committed to publishing our results. So if I had any, I would be telling you them, of course. And I hope that others would too, if they have results as well, especially in the audience.
Okay, one question I'm actually a colleague of mine from India.
Next question, just a question. This is the market building questions. Given the context that we're in San Francisco as a biotech community with for-profit accelerators that are building businesses, getting investment ready, and helping raise capital. And given the context that many global impact investors are investing into countries like ourselves, that's doing due diligences with flights into new markets, not really knowing local context, is there a space for us to disrupt and really look at for-profit impact accelerators that are incentivized around the success of the business, not a TA grant? Because I think what I get a sense is that a lot of the accelerators that we have in the market are not necessarily working so hard for the entrepreneur to get the investment ready, to get them out to investors. They're really working hard for the and so I guess my question is what I and one we're kind of we realize in South Africa is early stage entrepreneurs are going to pay for that BDS not in a grant manner, but actually BDS equity, because they don't have access to networks, they don't know what the investors want, they know that you manage and they're willing to do that work. So it's a quick question on is there maybe a partnership or really exploring new acceleration models that take some of that technology community and actually getting down back to
Yes, there is. And I've had conversations over the last few days with 3 different groups looking at 3 different funds and different geographies, trying to find ways we can find alignment between the early stage investors, the incubators, the accelerators, and other players in the space. So we've been in discussions with different roles that we can have, trying to find win-win-win-win-win scenarios with 6 different players coming to the table, all with different agendas, but all trying to move them forward. So hopefully there'll be some good case studies in the next couple of years that show, did this work out, was it a win-win-win-win, or what were the losses and what were the challenges. But yeah, I totally agree, I think the space needs to be able to get consensus line.
Max, I would add that in-country accelerators should also zoom in on connecting sources of capital who are supporting in-country social enterprise to local business executives or other business mentors and local participants within the investor syndicate. Even if it's a small amount of money, if it's meaningful, having that syndicate be inclusive of some funds or high net worth individuals that are in country is probably a pretty important step to include.
Just have one quick question / comment on that, and that's if it is equity, and as Miguel said, equity is the most expensive form of investment. Would there be a problem of adverse selection in that the ones that can get technical assistance or scale cheaper or through their mentors would be less likely to be part of this accelerator, and the ones that need the most help and less likely to reach that equity, you'd be able to work more closely with. So just something to kind of think through.
The other thing I'd just add is that, I see a lot of accelerators actually starting funds too, and so we've seen that in particular in emerging markets even more so than here. And I caution around that too. Just you have to make sure that it's all pre-negotiated. I mean, negotiations can get hot, and people can feel betrayed if they felt like first you were supporting them, and now you're negotiating to get the best deal against them. And what position was it? What was your intentions all along? All that kind of stuff. So I think it can get kind of risky. And I'd say look at the Village Capital model. I mean, I'm on the board, so I'm biased, but I think it's a pretty remarkable model, and they do take an investment in it. And that investment's from a donor-advised fund. But it's all pre-negotiated, and the entrepreneurs themselves, and they're the ones who pick who gets that investment. So that peer model actually really does great things. When we see that the entrepreneurs share and learn from each other a lot, it's pretty remarkable.
That's a great point to end on. And but what I want to do now is to thank my panelists. So. Terrific experience. You can catch them at our next 2-hour segment. I want to keep us moving on time. We have a 15-minute break, and then we're back in here for a term sheet workshop. So thanks again.